I will call the meeting to order.
I'll do a roll call. Good morning. Landon Moore,
Present.
Mark Gardner,
Here.
Stephanie Elliott Williams, David Holly,
Here.
Stephen Carter,
Here.
Gregory Coleman, Derek Challenger,
Here.
Trey Burke,
Here.
Councilman William Dotson, Perry Wilkes,
Here.
John Morrison, Brian Birnbaum, Jim Whitney.
Here.
And we do not have a quorum.
So with that, we'll skip approval of the minutes and roll right into Greystone. Brian, Jim, want to go ahead?
Hey, Brian, you can pull up the deck if you'd like, or we can, but everybody here also has a meeting book, so if you just want to reference the pages.
Yeah, maybe I'll just reference pages.
Sure.
By the way, can you hear me, and is there an echo?
No, all clear.
Great, perfect. Okay, well, thanks everyone for allowing me to participate virtually. I'm sorry I can't be there. I look forward to seeing you all again in person soon. And thanks for your flexibility on coordinating with my schedule. It's been a little bit of a crazy day with college stuff going on with my kids, so I appreciate the flexibility. I'm going to talk about the first quarter, probably more importantly, give you an update on April, given sort of the extreme levels of volatility that we've experienced. And I know Jim's going to talk about sort of the outlook in light of everything that's going on, from government efficiency stuff to trade negotiations and the impact that that's having on the broader economy, and eventually flowing through the equity markets, in particular bond market volatility is pretty extreme as well. But for the first quarter, maybe if we could go to page, bear with me a second. Let's start on page, sorry, find it.
What page?
Let's start on page 20, if we could. Perfect. This is just a quick snapshot as of the end of the first quarter of this year about where we stand in terms of broad asset allocation relative to the long-term policy targets. As you know, we've got 70% equity target that we've been sort of implementing and adhering to for quite a while now. About 22% or so target in fixed income, 8% in alternatives, which is real estate and a couple of hedge funds. You can see at the end of the first quarter, we were effectively spot on our investment policy targets, slightly overweight to equities, but certainly no material bet being placed on equities versus bonds in terms of where we're at the end of the quarter versus what the long-term strategy is. As you know, markets were quite volatile in the first quarter. It's hard sometimes to remember back, but believe it or not, the first 6 weeks of the year, the stock market was positive. So we got off to the start to 2025 on a pretty strong note. In fact, the S&P 500 was up, call it high single digits, 7-8% in the first 6 weeks of the year. And then, of course, from February 19th on, effectively the bottom dropped out of the market as the administration talked about and eventually implemented tariffs that were beyond any worst case scenario that anybody thought was even possible. That sent the market in a tailspin since the middle of February, and with some backing off on those tariffs, with 90-day moratorium on everybody except China for all intents and purposes. The market since that announcement has rallied. I'll talk a little bit about kind of that extreme volatility and the impact that it's had. But I just wanted to kind of point out the fact that the first 6 weeks of the year, the market was positive. For the full quarter, the S&P was down about 4% for the first quarter of this year. The Russell 2000 was down 9%. Believe it or not, non-U.S. equities were positive. EFA developed markets outside the U.S. were up 7% this year. And emerging markets were up 3%. So yes, the volatility in the first quarter was elevated, but it really was a U.S. equity market phenomenon because non-U.S. equity markets generated some reasonably strong returns. And the fact that we've got a portfolio that's very globally diversified, the impact of the volatility that we've experienced in the U.S. is somewhat mitigated when we look at the overall portfolio. We've got a good chunk of our portfolio, of our equities, about 35% of our equity portfolio is in stocks outside the United States, and that's right in line with what the broad market looks like. So although we had this extreme volatility, the fact that we were able to generate some positive returns through our non-U.S. equity exposure had helped mitigate some of that impact. April, the volatility was even more extreme than it was in the second half of the first quarter. But when you look at the whole month of April, again, the volatility was somewhat mitigated by the fact that the first half of April was really weak and the second half of April was really strong. When you look at the whole month, the S&P was down less than 1%. And I think, that gets a little bit lost in some of the headlines and all the doom that we hear in the media. The reality is the decline that we experienced in April in the U.S. equity market was pretty uneventful. Now, how we got there was extreme. In fact, the first week of April, the S&P 500 index was down. I just jotted these numbers down. It's not in the book. The first week of April, the S&P was down 14%. And really, since the lows on April 7th, the market rallied over 15%. So again, when you look at the bookends of the beginning and the end of the month, not terribly interesting, nothing to see here. But when you lift up the hood and see the range with which we traded within, pretty extreme volatility. Now, we saw the non-U.S. equity markets in the month of April continue to provide some of that protection. So again, we've got a very globally diversified portfolio. And so the declines that we've seen in the U.S. equity markets, even through the month of April, having a very limited and mitigated impact on our overall portfolio. And that's the whole point of being diversified, not having all your eggs in one basket, spreading it around to lots of different places. You avoid sort of the extreme outcomes that tend to happen in any one region of the world. So let's maybe go to slide, let's go to slide, sorry, find it, 19, one prior, and then let's talk about, in light of what I said, performance. So, again, with markets down, equity markets in particular down, in some cases close to double digits in the first quarter, the Russell 2000 index being down 9%. Our return for the quarter, net of all fees, was slightly under flat. We were down 7 basis points for the first quarter. And that compares to being down 52 basis points on the benchmark. So a couple of things to mention. Our effectively flat return, net of all fees, net of the manager fees, net of our fees, net of all fees. The benchmark's return, this group will recall, we made a benchmark shift at the end of last year that was effective 1/1 of 25, where we incorporated the broader global U.S. equity markets as our equity target. And so that's reflective in these numbers. So with all the volatility that we've seen, we had effectively a flat return, protected capital relative to our long-term policy targets, which would have been down 52 basis points. Now, the primary reason for us being able to beat our benchmark in the first quarter was that the active managers we had in place really across the board on the equity side did a really nice job of adding value, and we can talk about some of those. In addition to that, the two hedge fund managers we had in place generated returns in the 1.5% to 2% kind of range, and that was significantly better than hedge funds more broadly, which were down in the first quarter about 2%. So we had some nice outperformance from a couple of the hedge fund managers, and we had some really nice outperformance from the equity managers in particular. So if we could go to slide, bear with me a second. Slide 34, here's a listing of all the managers and the investments we have in the overall portfolio. I'm just going to focus on a few. You might recall we did a fair amount of restructuring to this portfolio in the middle of last year. We moved away from some underperforming managers. We added in some a global equity allocation so that we can put the onus on an active manager to be able to move the portfolio to U.S. or non-U.S. based on where they perceive value. And that was an important component about why we were able to outperform our benchmark in the first quarter. Not necessarily because they were skewed to non-U.S. stocks, but because the portfolio they built looked very different than the broad global equity markets in terms of the types of stocks they bought. And it just so happened that the more defensive names, the less technology-focused, high-growth kind of names, which suffered in the first quarter, is what really drove some of that outperformance. And if you can see, you can go down halfway down this page here, you'll come across something called GQG Partners, GLB Qual. That stands for GQG Global Quality Fund. It's a fund that's a global equity mandate, but they invest in high quality companies. That portfolio was very defensively positioned in things like utilities and things like the wireless carriers. Those kinds of stocks held up really well in the volatility that we experienced in the first quarter. And you can see they outperformed their benchmark there by a couple of hundred basis points in the first quarter. We had some good performance as well from one of our emerging market managers. You can see Pzena there. They're a little bit further down the page. They're a value-oriented manager, outperforming by almost 2x, a little more than 2x the benchmark. We pair them up with a more growth-oriented focused manager, you can see right below, and they struggled in the quarter. They struggled because they were overweight in India and had some really bad stock selection in India. India was one of the weaker performing emerging market countries in the first quarter. But when you put the two together, it's a portfolio that did well relative to the broad emerging market benchmark. If you go up to the top of the page here, closer to the top of the page, the first two rows there, Congress and Reinhardt, those are two small cap managers. Again, they generated negative returns reflective of the markets in which they're investing, but they went down less than the benchmark. So anytime we can go down less than the market, that means we don't have to go up as much to recover the lost value. And that's an important trait about how we put the portfolio together. We prefer to outperform on the downside and lose less money than the broad market because we don't have to recover as much. Generally speaking, we're probably going to lag a little bit when markets are rallying, particularly when they're rallying strongly. But that profile of protecting on the downside is a really important way to compound capital over the long term. I don't know if there's any questions. I can go into a lot more detail on this stuff, but again, the volatility that we're seeing in the quarter, first quarter, was mitigated to a large extent by good active manager selection and by global diversification. Again, that extreme volatility in April, we're seeing kind of the same dynamic in our portfolio where we're effectively flat to slightly positive in the month of April, despite equity markets going down, U.S. equity markets going down 14% and then rising 15%. So I would say we're really well positioned for this volatility. Some of the things that Jim and I are thinking about is we're a little bit underweight large cap U.S. equity. We're looking at potentially some opportunities to top up that exposure a little bit. But again, it's not a material bet one way or another. It's a portfolio that's working well as we would expect it to be performing given the environment that we're living through. And again, first quarter, really, really good results despite the slightly negative return. So with that, I'll see if anybody has any questions. I'm happy to talk about anything that's on your mind or anything you want me to go into greater detail on.
Hey, Brian, I've got a question.
Yep.
Do your folks tend to believe that the entire year will remain volatile, or do they think that the tariff situation will kind of settle down within the next 90 days or so? Any thoughts on that?
The expectation is that markets will continue to be volatile, and they will likely follow the announcements of any sort of trade negotiations or challenges with respect to trade negotiations. So, if I think about it from a couple of different ways. We're in the midst of earnings season, first quarter earnings season. Earnings results for a lot of the companies that have reported have been pretty darn good so far. The challenge is that a lot of them are sort of pulling guidance for the rest of the year because nobody really knows how these trade negotiations are going to evolve. What is clear from a macroeconomy perspective is the economy's slowing. And the risk is the longer this trade stuff drags out and there's not clarity or resolution on this stuff, the greater the likelihood that the economy is going to dip into a recession. So if we can get some good news and start to hear some deals that have been approved, and by the way, they don't even have to be better deals than what we had originally. There just needs to be some positive movement on the new trade deals getting put in place so that we can remove that uncertainty from the market and so that companies can then know what the landscape looks like so they can start reinvesting in their businesses and consumers can start spending again. So, David, I guess the long answer to your question is yes, there's going to be volatility in the market the rest of the year. And the longer this trade stuff drags on, the higher the likelihood that the economy dips into a recession.
Okay, thanks.
Guess or could already be in recession.
Fair point. Yes.
Guess now that we have the Q1 print negative,
Yep. exactly.
Although last time we had 2 quarters, they didn't call a recession, even though it got revised later. Can you just remind us, just quickly, and I know you don't have a lot of time and wanted to recap what happened in April, remind us the changes that you made to the portfolio last year. Was one of them, or 2 questions, remind us what the changes were last year, and how much underweight is U.S. large cap at 35%? So that's roughly half of the equity portfolio, I think. Should it be like 40%? It would be at the benchmark?
Yeah, Landon, let me take the first question first. The changes that we made in the middle of last year were principally around the active managers we have in place. So we swapped out of we put 2 new small cap managers in place, and you can see that on the screen on the top page 34. That's Congress. That's Reinhardt Genesis. You can see it in the case of Congress, since we put him in place in the middle of last year, outperforming by 300 basis points. Reinhardt kind of right in line. But I would, and then we made some changes to the active component of international equity, to the active component of emerging markets equity. But I would say the more substantive change that was made was the addition of this global equity manager. Again, with the idea being that over the long term, they're going to effectively reflect the regional exposures within the broad global equity benchmark. The broad global equity benchmark, in round numbers, has about 65% in U.S. stocks, about 35% in non-U.S. stocks. Now, if they see value in U.S. versus non-U.S., they'll move the portfolio to look different from a regional perspective. That's one lever they have to add value. And then, of course, the individual stocks that they put in to implement those views have the potential to add value too. I'll tell you, at the end of the first quarter, they were about 70% in U.S. stocks. So you would think, okay, they're overweight U.S. stocks. U.S. stocks did worse than non-U.S. stocks. We should have underperformed with that. But because the portfolio was so defensively positioned and those stocks did really well, that's why you're seeing positive returns here, given the negative return of the benchmark. In terms of, if you go to slide,
I think it's 45.
21. Landon, this will answer the second question you raised. So if you look at the table on the left-hand side, relative, so we show the benchmark's exposures.
So you're actually overweight U.S. large cap.
Yes, what did I say underweight in my comments? I meant to say overweight. If I said underweight, I apologize. But we are, yes, not a huge overweight, but a slight overweight nonetheless. And part of, by the way, part of that overweight position there in large cap is because some of the small cap managers have a little bit of their portfolio in some of the bigger companies within their benchmark that gets reflective as large cap exposure. So it gets a little bit complicated when you look at the individual holdings and how it gets sort of decomposed on a holdings basis versus what the portfolio kind of looks like from a top-down perspective.
Did you remove, when you hired the global equity manager, was that the manager that you replaced was a U.S. large cap active manager?
We sourced the funds from partly from non-U.S. stocks and partly from U.S. stocks. We did, in the past, have an active large cap value manager in this portfolio. We moved out of that positioning before the restructuring that occurred in the middle of last year. So there was an active large cap manager in the portfolio. It was, we moved out of them before the restructuring that occurred in the middle of last year. So we sourced it, again, some from the active non-US equity, and then part of the exposure came from reducing our small cap exposure a little bit as well.
Hey, can I ask a question here? This is Stephen Carter.
Yes.
Given the position that we're in right now, do you anticipate having to make any more adjustments in the second, third, and fourth quarter? I've kind of heard this described as like, if you accidentally set your house on fire and the fire department comes in and put the fire out. They did a great job of putting the fire out, but you got a partially burned house. And at some point, you're going to have to do something about the portion of your house that was burned. You can't just continue to live there, So
Yeah.
is there any projections as for adjustments as we move forward?
Well, so we do make tilts within the portfolio. The one thing you will not see us do is make significant changes to what the long-term strategy is. So we've got a 70% target allocation to stocks. If we think stocks are going to go down with clarity, you will see us underweight stocks. You might see us go to 65%. The investment policy allows us, I believe it allows us to go to 60%, but you won't see us go to 20%. And the reason we won't do that is because that's a huge risk relative to what our target is and what our strategy is. And as much as we think our outlook may be right, at the end of the day, it could be wrong. So we'll give you a perfect example. If we had perfect foresight that tariffs were going to 145% tariffs are going to be put on China, tariffs beyond anybody's worst case scenario was going to be put on the rest of the world, we might have said, okay, let's go to the maximum underweight to U.S. stocks. The challenge is nobody really knew that until it was actually discussed. That's why the market was down so much. Arguably, we could have been reducing equity exposure during that first week in April, reflective of the market decline. Then we would have missed the significant rally for the later part of April. So it really is a balancing act around what is our outlook, how convinced are we that outlook is actually going to play out, and what is the risk and what is the impact if we're wrong. So again, sort of a long-winded answer, are there any changes that we're thinking about? We look at this portfolio all the time. We underwrite the portfolio every day to make sure it's consistent with kind of what our current thinking is. I would say at the margin, there could be some changes that we might think about, but nothing that's that is significantly different from the way the portfolio currently looks today.
Okay.
Can I sort of summarize that and let me know if I'm speaking correctly here? So we have the long-term strategic strategy of, in simplistic terms, roughly 70% equities, 30% stocks. Greystone has the ability to, modulate up and down around that 70-30. Is it safe to say, Brian, Jim, that nothing that has happened this year is significant enough that you think you'd recommend us changing that long-term strategy, and you still believe that is a good place to be? And if you thought there was something big enough to make a change to the strategic strategy, you would sort of tell us or let us know?
We would.
Absolutely, Landon. That's exactly right. We think the long-term strategy continues to make sense given the funded status of the plans, given the risk tolerance of this board and the city council. I'll give you a little bit more insight into maybe some of the things we're thinking about and a potential change, which may be different than what you're thinking, given everything that we see in the world. If in fact the economy continues to slow and trade negotiations drag on for an extended period of time, we talked about the fact that the longer that isn't resolved, the higher the likelihood the economy enters recession. Right now, the market, the stock market, given that it's rallied 15% from the April 7th lows, is not predicting a recession is coming, despite the fact that we had the other day a first quarter negative GDP number. If the market starts to think about a recession is becoming increasingly likely, what you'll see is equity markets probably sell off. And if equity markets start to reflect that, we are much more likely to be buyers of stocks than we are sellers of stocks. So if we get down to, back to the lows that we saw on April 7th and arguably trade through those lows, we want to be buyers of stocks on the eventual recovery. So those are the kinds of things that we tend to do, as opposed to dramatically changing the risk profile in anticipation of what could be an equity market decline. Does that make sense?
Yes.
It does.
With that, can we let Brian go? Jim, can you cover what happened in April?
Yep. Happy to do that.
Great.
Any other questions for Brian before you breaks?
Thank you, Brian.
Thank you. I appreciate it. And again, appreciate your flexibility and look forward to seeing you all soon.
Thanks, Brian. Okay, so I will, I'll direct you to the front of the book. And we'll start on slide 5. So I kind of want to get right into what we're forecasting, because that was it's most important, and it seemed to be where a lot of the questions were resonating. And I think what our takeaway here is that Liberation Day was a massive shock in its magnitude, to say the least. It was trying to do too much, too fast, everywhere. And what happened was, importantly, it was too much for the consumer, it was too much for businesses, and it was too much for investors. And we know that because we had a collapse in both business and consumer confidence. And we'll look at a slide that demonstrates that in just a minute. So in our view, the U.S. economy is in a race against time. A race against time. We think that the tension pressures could potentially dissipate quickly enough to prevent economic damage and a sharp reduction, sharp contraction in economic growth. Our outlook assumes that tariffs in place will boost inflation first, and then with a lag, we'll see weakening economic activity. And that's an important bedrock of our view that the Fed will be on the sidelines. Kind of key to all of this is where is the Fed? So specifically, if you can look up here, you can see that we've cut our base case for a soft landing to 30%. And that was cut in half from the last month. In terms of our forecast for GDP, we have 0.8% growth forecasted for 2025, 0.7 for 2026. Those were recently cut. And I think that is so close to no growth that a recession call is almost a coin toss at this point. Our recession odds are now at 40%, and stagflation, which we'll review in a few minutes as well, is at 30%. Morgan Stanley sees the CPI, Consumer Price Index, peaking in the third quarter of 2025 at around 5%. We have unemployment rising from 4.2 to 4.9%. And ultimately, we think by the end of 2026, the Fed is back on track in its easing campaign, and we see that Fed funds terminal rate at 2.75%. But that is a ways off, and keep in mind that's from the 4.25% to 4.5% range that we're in today. And the 10-year Treasury year-end target remains at 4%, which it has been for a while. Earnings, we'll look at this more closely in a future slide as well, and the market is still forecasting 12% growth for this year, 13% growth for next year, and Mike Wilson, our chief equity strategist, thinks those are optimistic. He thinks it's probably closer to 4 to 5%. So we have
That's real optimistic.
It's quite well below consensus, however, still. And I guess the good news is that this is a big earnings week, and so far earnings have been pretty good, all things considered. So our best guess is that we'll be in this trading range between 5,100 on the S&P on the low end and 5,700 on the upper end. But we recognize that we're at the upper end of that band presently. If our bear case comes to fruition, then we have an S&P 500 target of 4,600. So from where we're at today, that's about a 16% decline in a full bear case. So let's look at some slides in some detail. I'm going to turn to slide 6 for a moment. And here we're looking at the NASDAQ.
Page
6, slide 6.
7, 6.
So here we're looking at a chart of the S&P 500 and the NASDAQ with some important moments noted on the slide. And I think it's important to recall that this bull market had two fundamental pillars built into it. One was a deep belief that the Fed would be able to get us to the 2% inflation hurdle, their target, and that would deliver a soft landing. And alongside that, we'd experience a full easing cycle, taking the Fed funds rate from 5.5% to sub 3%. And we know this was a foundation of the bull market because if we look at this run since 2022, 2/3 of this was a result of a multiple increase. So investors willing to pay more for the same dollar of earnings. It wasn't driven by earnings. So there must have been something else moving this market up, and it clearly was those two things I just mentioned. I think also it's important to note that artificial intelligence, generative AI certainly helped during this period. But with the DeepSeek announcement, which happened, I think it was late January, it was a wake-up call to the Mag 7 that there might actually be other winners of generative AI, and it wasn't going to flow just to a concentrated group of U.S. companies. And building all the data centers that are GPU intensive might not have the same rate of return on investment that analysts previously thought. And then, of course, we have Liberation Day. If we look at the next slide on the left, I think volatility since Liberation Day on April 2nd has been really nothing short of stomach churning. You know, I think if you just look at the month-end numbers, you weren't paying attention to what was happening, you'd say it was a pretty uneventful month. But as Brian outlined, it's been very tumultuous. the NASDAQ from trading peak to trading low was down 30% during that time period. And importantly, the S&P 500 had a 20% bear market correction during that period as well. Intraday peak to intraday low. And the CBOE volatility index, the VIX, which is also like a fear index, rose through 55 and also had a technical bear market. So you can see it was precipitous, and most of that was just driven by the surprise, the order of magnitude of these tariffs. On the right, you see the 10-year U.S. Treasuries yields and that enormous spike. We're going to come back and talk about that in just a minute, but that had a profound effect on delivering the pause in the tariffs. The next slide, we spent a lot of time talking about the Mag 7 and the impact it has on the index. We spent a better part of a year talking about this. And as we're looking at this, as you would expect, it was the part of the index that had done exceptionally well. It was also one of the most expensive. So when the market pulled back, you can't be surprised that this tech-heavy NASDAQ, and particularly the Mag 7, was going to bear the brunt of it. Importantly, I think the forward PE of the Mag 7, which was at 30 times forward earnings at the peak, is now at around 21%. So much more fairly valued. Over that same period, the PE of the S&P 500 fell from about 22 to 19. I know it depends on what those forward earnings are, but nonetheless, there's been reasonable compression, certainly in that Mag 7. The slide at the right is just more of a dissection of the S&P 500 and its historical valuations. The key takeaway there is that despite this compression in multiples for the broader index, these stocks are still not cheap if a recession is coming. That's essentially the takeaway from the valuation slide. Let's move to the next slide. And this is what I referred to in my opening comments about confidence, sentiment. So this policy uncertainty that I talked about is a unifying theme across the consumer, small businesses, and CEOs. And whether we're looking at the upper left, which is the University of Michigan consumer sentiment, so how's the consumer feeling about the economy? You can see now it's fallen precipitously, like a rock. If we look at the bottom left, small business optimism, same thing, massive correction. And when our investment bank is talking to global CEOs, you can see what their confidence looks like on the bottom right. I think that the key to this pessimism is that if you two things. One, if you look at this, it's actually at or below where we were during the pandemic. So we're at a period of time, we're navigating a global pandemic, the economy is completely shut down, and that's the same level of confidence that both consumers, small businesses, and CEOs have. It's breathtaking when you think about it in that light. The contrarian aspect of this is when this pessimism gets this extreme, it typically is a reasonable entry point to add volatility or to add risk to your portfolio. This next slide is talking about manufacturing, which is an important component of the Trump administration's tariff plan. And when we're looking at this data on the upper right, new orders for manufacturing, you can see how much that's collapsed. And then if you look at the bottom left, these are manufacturing prices paid, a very significant spike upward. So the point of this slide is this data has a very stagflationary feel to it. When we look at demand slowing quickly and prices moving up quickly. It's not something we see very often. This next slide is the earnings slide, which we've looked at previously. And as I mentioned, Morgan Stanley, we've cut our numbers for the market. The middle light blue is the 2025 estimates at 268. Morgan Stanley cut theirs to 257. And above that, you see the 2026 at 306, and Morgan Stanley's at 281. So we're still 7 or 8% below where the index is. And I can tell you that as a result of all this movement, Brian and I spent very considerable time thinking about adding to equities when the index was down 18, 19%. And the challenge for us to add at the time, which was the lower end of our trading range, was the earnings estimates. So Mike Wilson, our chief equity strategist, his view is that it's going to take a while. We probably won't see any of this manifest itself through earnings. It's still the quarter that we're in presently isn't really reflective of the tariffs. But if they stay at or around current levels, that will work its way through those earnings estimates by mid-year. And that's what really gave us pause, is this disconnect between where the consensus for earnings are in our views.
So this 12% growth, that's the market sort of consensus, not in Morgan Stanley think that's aggressive?
That's correct, yeah.
But like 12% growth is pretty good.
It's great.
Yeah.
Yeah, it's wonderful. But from here, it's a bit of a hockey stick.
Do you know, is there some kind of definition that's accepted of what would constitute stagflation over how long? Is it like some differential between GDP and inflation or something? Like if inflation's at, X% above like growth for some period of time?
Like a recession, 2 consecutive quarters. I've not seen anything that defines what that period is. The slides I just showed you would indicate that that's exactly what we're experiencing.
We've already been in a period where inflation's been above growth for 2 years now, right? A couple years?
2+ years. Yeah, 2.
I mean, that's, I guess, not healthy. I mean, for inflation to be higher than growth for an extended period of time.
The difference for part of the 2-year period is the demand component. We had an insatiable consumer spending cycle, so the demand was pretty robust, certainly coming out of the pandemic. Here, we're seeing demand weaken, and we're seeing inflation spike. I think the other important thing to keep in mind is, prior to the tariff announcement, Liberation Day, the economy was already slowing. We knew that. So what happened prior to the tariffs being imposed, we saw a earnings miss from Walmart, a rare occurrence. Very predictable, very stable earnings. They missed. We saw a miss from Costco, another stalwart, rarely misses a quarter. And we saw some smaller retail players like Target miss. We track credit card spending. It's a pretty good leading indicator of the economy. And we saw credit card debt explode to over $1 trillion for the first time. And recently we noticed that the percentage of Americans that are paying the minimum on their credit card is now north of 12-13%. And that data only goes back, I think we only have it for 10 or 12 years, but so, and this was all happening before the tariffs. So demand was already slowing. A lot of that government excess stimulus money had completely burned off.
you're expecting the Fed to stay on the sideline through the end of the year?
We are, and that is a non-consensus view.
Yeah.
I think there are, it changes quite frequently, but now I think there are 2 to 3 cuts expected this year. When you think about the Fed, they have a dual mandate of full employment, and the employment level is, I think by most economic standards, considered to be full employment today at 4.1%, and have an inflationary target of 2%. So Chair Powell was asked, that you're sort of stuck in a corner, and how do you think about whether you should hold rates where they are or whether you should cut? And his response is, it depends. Depends which one is weighing more heavily on the economy. So our view is that with the inflation forecast CPI peaking at 5% in Q3 of this year, that is a tough backdrop for the Fed to cut rates.
If employment starts increasing like it's expected, though, then where do you go?
Right. And our view with a no-cut forecast in 2025 is that the inflation in the economy will weigh more in their thought process than
The employment?
at least in the short run. They'd have to see a pretty meaningful and sharp deterioration in unemployment. And as you know, that moves pretty slowly.
Where's the political pressure in there?
There's a lot of, that's independent of the government.
Really?
And hopefully that remains the case.
Do you have any sort of pure treasury exposure? So like in the event of a recession, you'd actually have something you could sell to overweight equities. So if we had a recession, the credit would also be down, possibly, or maybe flat. If this recession scenario does occur and S&P goes down to the 4,600 in the bear scenario, I guess would you be prepared to I guess overweight equities? And I imagine you wouldn't go 10% overweight, but I think you said 5 maybe would be, and maybe that's even an extreme scenario.
I think as Brian communicated, we want to make sure that we don't make incredible bets in the portfolio because we could be wrong. But when there are high conviction tactical opportunities that present themselves, we're not going to be afraid to make those tilts in the portfolio. We got very close just a couple weeks ago. So yes, to answer your question, we have liquidity within the portfolio to be able to make those tactical shifts.
Do you have the ability to use futures?
No. It's not within our investment policy statement.
I think part of his question was which funds are you going to pull from to buy those equities?
We have 2 fixed income managers, Loomis Sales being one that we would use. And we can get fairly liquid quickly, those managers.
You got 13% in there.
And it may not be U.S. equities, it could be European equities. I'm not sure unclear what the opportunity set might be, but we have the ability to do that. Yeah. So I'll cover maybe one more slide with you, and then I'll wrap up my comments. On slide 12, we looked at the Treasury market a few minutes ago, and we saw that spike in the 10-year. And here on the left, what I want to highlight is that we get this question like, why did this current administration actually pivot and pause and put this 90-day sort of grace period to negotiate trade with 80, 90 countries around the world? And because the stock market had been down 20%, and that did not seem to capture any of their attention. But it was the U.S. Treasury market that captured their attention and caused the pause. So yields were spiking The 30-year was above 5%. The 10-year was over 4.5%. And this was right in front of, we had very long auctions coming, long dated. I think we had a 10 and a 30-year Treasury auction. So we had soaring bond yields, rising Treasury yields, credit spreads started to widen, default insurance costs started to move up very quickly, and the market began to indicate it was not only struggling with the prospects of a recession and inflation risks, but a liquidity squeeze. And this is when the administration blinked, because stock markets can go up and down around the world, but when there's a potential liquidity squeeze, that's when the heart of the financial system stops working. And I think Treasury Secretary Scott Bessent knows this, and he worked for George Soros. He headed up his London office. He also had his own hedge fund, Key Square Group. He had over $5 billion of assets he was managing. He's very sophisticated investor, and he knew the implications of this potential liquidity squeeze. And that was the reason they paused. That's the reason they put in the delay in the tariffs. So if you want to know what drives their thinking, it's the bond markets, Treasury market, not the stock market. So I'll stop there unless you have any other additional questions for me.
One question.
Sure.
In the end of the year, we have to see a time value of assets in the report. I don't see one here.
That was at the year-end report?
I think so.
Yes, I think it's included at every year-end report, not the quarterly, but if you'd like to see that, I think we can generate that.
Next meeting would be fine. Thank you.
Thanks, Jim.
You're welcome.
Right. So I don't have a whole lot to cover, so I'll go through it pretty quick, and we can probably give everybody a little bit of their day back. So start off with the thing that everybody always wants to know, and that is the funding status. At this point, it's dropped a bit. 68.8 for the fire and police, and about 72, a little over that, for the supplemental. And this is entirely due to the fact that the annual contribution to the plan, which we usually see in February, had still not been funded as of the end of March. So investment performance is not the cause here. This is entirely just the delay in the funding. All right, and then again, the supplemental down to 72%. All right. And then moving along, I'll just hit the highlights here. The 2025 webinar schedule has been shifted around in light of all the market volatility. The Social Security sessions originally scheduled for April were canceled. Those have been added for later in the year in October. And then a new May webinar was added on the topic of navigating market uncertainty. So, again, these are free to your participants and employees. So, if they take advantage of them, there's email reminders sent out on a pretty regular basis for them.
I don't think I've seen the schedule at all. How do we get this actually to our employees? Because I haven't seen the schedule.
If you have an email on file with the plan, which any participant that's registered their account does, that's the method of communication.
Internal participants for that plan. Right. Okay.
Okay.
You get it?
For the plan checkup, overall, a slight decrease in the number of participants, and that's due to a number of participant deaths. We'll show that slide a little bit later. Again, only one active employee in the fire and police system plan. And overall, cash flow has been relatively steady. The one spike there in the fourth quarter was due to the supplemental payment, but overall pretty constant. And then this is the overall quarterly activity. And you've got an additional 5 people who are now retirement eligible. New distributions started for 2 participants, and no deceased participants in the fire and police plan. And then for the supplemental, 6 active employees. And again, same thing, the cash flow is pretty consistent with the exception of the supplemental payments in the fourth quarter. And then here's the activity for the quarter. 1 newly eligible retiree, and then 6 deceased participants in that plan. Then just real quickly, for the most part, the cost of the plan are again consistent from prior quarters. And that is all that I have. So
I've got a question, but I think it's more towards the city. Did we making the contribution, or we just delayed in making the contribution?
That's the question I just asked. Yeah.
I've just asked that question.
Okay.
I'll report back.
Do we have any idea where the funding status would be if the contribution had been made?
I don't know for sure. Again, John Morrison, who couldn't attend the meeting, is the actuary. He said that essentially most of the funding decrease was due to the contribution, so I would say it would remain relatively stable had the contribution been made.
Thank you.
Any other questions for John Hancock? All right, thank you. Appreciate it.
Sure.
With that, I see we have Stephanie Elliott Williams has arrived and Councilman Dodson. Can we notate that?
Yes.
In the minutes? And now we do have a quorum. I think we can vote on the minutes from the prior meetings. I think that was the only other. Well, let's do the minutes, and then I think we have. It looks like a quick update on the OPEB.
Yes, so year to date, or the total value is about 8.5 million, which is down about 2.4 million since the start of the year. So
The total asset value is down 2 million?
yeah.
Okay.
I gotta ask, how did that occur?
I got to call George Moore at PML and get him to tell me. I just got the information the other day, so.
Okay, that's pretty significant.
It is, and it's through March 31st, so.
Is that
The volatility in April isn't in there either. And it could be a timing thing.
Okay. When do we make our contribution to OPEB?
I think all at once at the beginning of the year.
Beginning of the year.
And we're not paying any of the benefits out of the assets.
Correct.
So that would be completely market return driven.
Right.
Okay.
That seems right.
I think I might go back and look at my emails. I think someone shared the quarterly report from that. If not, do you get a quarterly report on the investment performance?
I get one. It's pretty simple, and it's pretty dumb, so to speak. Like it's just the asset value as of the end of the month, and I get it monthly. So I don't know if they've really done any work to normalize it or take anything out. It just seems to basically be a bank statement.
If it's 8 to 6, that's like a 25% decline. That's much more. Jim, didn't you say that like markets were kind of flat for the quarter? Mm-hmm. Or equities?
Yep.
Yeah, there seems to be some sort of disconnect there. Okay. With that, can I have any discussion or comments on the minutes?
Do we need to approve them one at a time? or-
One at a time.
Okay. So we start with
November?
Can I have a motion to approve the minutes from
So
November?
moved.
second.
All right, everyone in favor?
Aye.
Aye.
All right, minutes from November 2nd are approved. Minutes for the February meeting? Any comments, discussion?
I move that they be approved as written.
Second.
All right. Everyone in favor of approving the minutes?
Aye.
Aye.
Me too. All right. With that, I think, unless there's any other questions anyone has, I think we can adjourn.
All right.